Let me give you a punch in the gut financial question. If the bills hit today, could you pay them without selling equipment, burning inventory, or praying for a miracle? If the answer is, I think so, then we need to talk about something most contractors ignore until they're in the red, the quick ratio. It's like the current ratio's no-nonsense older brother. It doesn't care how much lumber is sitting in the trailer. It only cares about what you can actually use to pay bills right now. So what is the quick ratio? It's calculated by your cash plus your accounts receivable divided by your current liabilities. But here's what that means in English. Cash, what's in the bank, real money, not theoretical. Accounts receivable, what you've invoiced and expect to be paid. Your current liabilities are what you owe in the next 12 months. Your bills, your payroll, short-term debt. Now notice what's missing. Inventory. No extra plywood, no backup pipe fittings. Why? Because you can't count on selling inventory fast enough to pay for an emergency. The quick ratio asks the tougher question, can you pay the bills without pointing your tools? So what is a healthy quick ratio? 1.0 or higher. 1.0 or higher means you can cover your short-term bills without selling assets. That's pretty strong. If you're 0.8 to 0.99, you're close, but you might need to dip into inventory or delay some bills. If you're below 0.8, you don't have enough liquid assets. You're guessing with your fingers crossed. So if you got $40,000 in cash, $60,000 receivables, and $100,000 in short-term bills, that's 40 plus 60 divided by 100, that's 1.0. You're in the clear. But if you got $30,000 in cash and 40,000 receivables and still owe 100,000, quick ratio equals 0.7. Now you're hoping the next check clears before the bills do. So why does it matter? Because it's one thing to look profitable on paper. It's another to actually have cash to operate. That equipment trailer full of tools, that's great unless you can't make payroll. That stack of inventory in the shop, fantastic, unless your supplier is demanding payment today. The quick ratio shows how close you are to a financial jam. It's the canary in the coal mine of contractor cash flow. So here's a real contractor example. Had a GC doing about $2 million a year. He kept saying, we're busy, we're booked. Why are we always tight on cash? So we ran his quick ratio. His cash, $12,000. Receivables, $68,000. Current liabilities, $110,000. $12,000 plus $68,000 divided by the $110,000 gives you 0.73. That means every week they were hoping to collect faster than they spent. No cushion, no safety, one bad pay cycle away from a crisis. We adjusted and tightened up his accounts receivable collections. We held back on early payments, moved his non-essential purchases, and built up a 30-day cash reserve. 6 months later, his quick ratio was up to 1.4. That's breathing room. So how can you improve your quick ratio? So number one, collect AR like your life depends on it, because it does. Set your terms, enforce them, follow up fast. Number two, don't overpay payables. If the bill says net 30, don't pay it on day 3. Protect your cash. Number three, build a cash reserve. If you got 1 to 2 months of expenses, that's a business that can sleep at night. Number four, avoid bloating your inventory. Don't buy materials early just to get ahead. You're tying up liquidity. Number five, refinance or restructure short-term liabilities. Spread large obligations to preserve your working capital. So here's the final word. The quick ratio is your financial pressure test. It answers the no fluff question, if the phone stops ringing today, could I still cover tomorrow? If your ratio is under 1.0, you're riding a line. If it's under 0.8, you're skating on thin ice and calling it a business. So ask yourself, do I have real money or just hope? Because you don't run a business with buried assets and delayed payments. You run it on cash and control. Track it, know it, strengthen it, and stop building a company that's one vendor call away from a crisis.